Hey, what's up, folks? Ryan Wheeler, United Residential Mortgage. Hey, today we're going to talk about mortgage insurance, otherwise known as MI or PMI or MIP. So PMI stands for private mortgage insurance, MIP mortgage insurance premium. There's all different variations of the same thing, mortgage insurance. So sometimes that word can make some home buyers tremble and homeowners tremble if they're paying it and just the sound of it and what they know from it. And I get that. It seems like an unnecessary expense when you're buying a home, but it's really not. It does serve a purpose, believe it or not. Nobody likes to pay it, but that goes with probably basically any insurance for the most part. We feel like it's not being really used for anything, and it feels unnecessary sometimes, but it does serve a purpose. And so we're going to go over today what it is and why do you have to pay it. So what is it exactly? Mortgage insurance or private mortgage insurance is an insurance that protects the lender essentially against your default. So many years ago and decades ago, when you were buying a home, you actually had to have 20% down to buy a home. The reason you had to have 20% down is because if a bank or lender has to foreclose on a home and they have to put that home up for auction and that home has to be sold at auction, generally they're only going to get 80% at best in the auction for it. So it's a way for them to be able to recoup the majority of their investment. If they lend 100% financing and it only gets 80% at auction, they lose 20% of the money that they lent. So it was a way for them to have a more low risk way to lend. And so what somebody did is somebody came up with an idea and said, hey, with that said, what if we come up with an insurance pool that will protect lenders in the event that that somebody does foreclose on the property? And so what happens is the homeowner will, if they don't have 20% down, they'll pay into this insurance pool. It's just like any other insurance, goes into a pool of insurance. If there's a claim by a lender, if a home's defaulted on, that lender can file a claim and they can then make up some of the losses in that claim. It's the same for all the programs. Conventional requires it. FHA requires it, but they call it MIP, mortgage insurance premium. USDA program requires it. They call it a guarantee fee, just a different name. And VA is the only one that doesn't require a monthly mortgage insurance premium. VA loans do not. But VA does have an upfront funding fee. And it's called a funding fee. It's essentially the same thing. You pay it up front. It's built into the loan. You don't pay it out of pocket, but it is built into your loan. So it is paid into a pool of insurance premiums, to help fund the program. And essentially for the same reason, if there's a default on the loan, a lender can file a claim with VA and then make up some of those losses in that. So that's essentially what it's for, guys. So it does serve a purpose. And I know that it sucks to pay it. I pay it. Other people paid it in the past. And it's just a kind of a necessary evil if you want to have the more home ownership access. If you want to go back to the old ways of where you got to have 20% down and that's the only way you can buy a home, then that would eliminate mortgage insurance. And you can do that now. You can do 20% down and bypass the mortgage insurance. When you have the mortgage insurance, though, it's not on a conventional loan, for example, it's not lifetime. So once you hit that 80% mark on your home, then you can you have the PMI eliminated. So some people ask, well, maybe I should just wait to save before I buy this home, save up the 20%. Instead of paying that PMI. Not necessarily, because the PMI is not as near as expensive as what you would think. And so the amount that you would pay over that period of time before you've had that home paid down to 80% and to have that PMI eliminated, if you did that versus waiting to save to buy a home in the first place, it's going to be a lot cheaper just to pay the PMI over that time and then have that PMI drop. Because if you wait to save the 20% and that takes you several additional years to do that, then you're going to end up paying a larger price for your home. So you're going to have price growth year over year is very common. So you're going to pay a larger price for your home and you don't know where the interest rates are going to be. So you could end up paying a higher interest rate at that point as well. So it makes more sense in most cases just to go ahead and buy the home now, lock that in, and then you can pay down your principal faster and pay that PMI off and have that PMI eliminate over time. Now, FHA, on the other hand, if you do less than 10% down, it is for the life of the loan. But if you get your principal paid down to 80% and you're in a position where you can refinance, then you'd be able to refinance into a conventional loan and eliminate the PMI altogether. So a lot of variety of ways to eliminate that PMI, but it does serve a purpose. Again, conventional 20% down, you can avoid that PMI altogether. There is something also called lender paid MI, and so that's lender paid mortgage insurance. LPMI is what it's referred to as. Basically, the lender's absorbing the mortgage insurance, paying that premium, but they're going to build that into your interest rate. So you're going to take a higher interest rate, but have no PMI. And so what that does is sometimes that can result in a slightly lower payment than the regular interest rate with the PMI. And so you just kind of navigate that, and that's what a professional like myself would do, is weigh those options for you to see what the best option was in those circumstances. So PMI lately on a conventional loan is so cheap compared. It's normally just better to take the lowest interest rate and that low PMI premium. So we can help you explore those options. That's what we're here for, is to kind of help navigate what the cheapest option is. But don't let the idea of PMI freak you out or scare you off in any other way. But that's what PMI is, guys. There is a cost of waiting, again, that we just went over. So I would avoid, waiting to buy a home to save up, unless you had to sell a home and you were going to be able to have that in a short window of time, have that 20% down in a short window of time. I wouldn't wait. I would go ahead, buy the house now. You can pay your principal down, have that eliminated later. So I hope you found this video helpful. Hopefully you understand what PMI is for, that it does actually serve a purpose, believe it or not, and it is somewhat useful because it allows folks like us to be able to buy a house who may not have the 20% down payment and may only have 3 or 5% down to put on a home. It's going to allow us to be able to buy a home, whereas before it wouldn't have. So this opened up the doors to a much larger pool, and most people, understandably so, do not have a 20% down payment. So it really expanded the real estate market, the home ownership rate, and long-term wealth for people. So it does go away over time. But if you need anything or have any other questions, please feel free to reach out. Give me a call, shoot me a text, schedule a time. My number is below. A link to my calendar is below to schedule an appointment, a call, whether it just be to just talk, Q&A, or if you want to do a full-blown mortgage consultation, more than happy to work up a pre-approval, work some options or a rate quote up for you as well. You can also check us out on our website, which the link to that is below. But my phone number is below, but it's 270-228-0075. Feel free to give me a call, shoot me a text. Love to chat more with you about it. Thanks a lot. Look forward to talking to you next time. Bye.